This Chat with the Experts is brought to you by Angie's List on 93 WIBC.
Welcome back to Chat with the Experts, brought to you by Angie's List. I am Kyle Hawk, and I'm crunching the numbers today with the help of Tim Dages, an accounting expert. He's talking with us today as income tax season approaches. We just discussed the importance of hiring a tax preparer, or why you may want to consider reaching out to an accounting firm. And we're going to talk about some specific income tax related questions here in just a little bit. But I want to go back to something, Tim, as we get back into the conversation. We talked about, hiring a tax preparer, someone to do your taxes for you. But now more than ever, there are all kinds of options to do your taxes on your own, whether it be online or otherwise. I wanted to ask, are there any common mistakes that you see people make when they're doing their taxes on their own?
One area that I've seen through the years has been in the area of IRA distributions, when somebody receives a distribution from their IRA. And the problem arises when they have an IRA that was a pre-tax deductible IRA, and then they also have a post-tax non-deductible IRA. And even though you may have two separate accounts, the IRS looks at that as one pool of money. So when you take $1 out, it's going to come a little bit from both accounts,
sure.
No matter which account you take it out of. And so the reporting part of that, what I've seen is that typically it's you end up putting more taxable income on your return than what you actually should pay tax on. And so that's a situation where, the IRS is they're really good about telling you when you didn't report enough income, but they're not very good about letting you know when you reported too much income. And so, it's different circumstances have come about that have brought that to somebody's attention, and we've worked through that situation and corrected that mistake.
Well, let's talk about that. If I have, filed my tax return and I know I made a mistake, what happens at that point? Is there a way to catch it or take care of it before it's officially filed? Well,
if you catch it before it's been filed, you can make the adjustment. If the return has already been filed, whether it's the current year return or a prior year return, and you come across some information that you realize was incorrect on that return, you have to go through the process of filing an amended return. An amended return is a form that is filed with the IRS or with the state taxing authority. And basically it says, okay, in one column, this is the information that was reported on my original return.
Yeah.
The last column is what the corrected information is. In the middle is the changes. You need to support those changes, whether they're an increase or a decrease in the amount of income that was originally reported, and then file that return. The unfortunate thing about it is if you left off income, there's going to potentially be some penalties and interest associated with that correction.
Yeah.
If the amount is small enough, and it is one that the IRS is going to catch eventually because of information that has been reported to them, it's recommended, or I would recommend, that you sit down and at least talk to somebody about it and see, but you may make the decision that it's less expensive just to wait for the IRS to send you your notice.
Okay.
And then pay the tax that's due off of that notice. There would be some, penalties, again, associated with that because you didn't report all your income. But overall cost involved may be less expensive to do it that way than it would be to go through a full-blown amended return. Now, if the issue's big enough, the dollar amount's big enough, you want to get that corrected as quickly as possible and try to help reduce the penalties and interest that are associated with that. Yeah,
very good information to know. While we've got you here, we kind of want to run through some just general tax questions that people may have as they start looking at their documents and filing their taxes. So let's start with this. Who can be claimed as a dependent?
Well, there's really two pools that can be claimed as dependent. One's a qualifying child, and that is basically going to be your child, whether it's a natural-born child, adopted child, could be foster child in certain circumstances. Stepchildren fall into that category. And so there's the relationship test, which is, that they're your child. And then there is the residency test. They have to live with you during the year. And then they cannot file a joint return with anybody else, unless they're doing it just to claim a refund. which can happen in certain circumstances. And then there's an age requirement. And the age requirement is they must be under the age of 19 or under the age of 24 and a full-time student.
Okay.
Then there is a qualified dependent or qualifying relative dependency, and that is somebody that is not a qualifying child. And it is, again, a relative of yours. There's an income limitation. They can't make more than $4,000, or they'd have to file a return on their own. And they also have to live with you for more than half the year.
So to qualify as head of household for the filing status, do you have to claim your child as a dependent?
In most instances, yes, but you can have a situation where a divorced parents and the custodial parent, the child lives with them, but because of the agreement in the divorce, the non-custodial parent gets to claim that child on their tax return. In that situation, they would not have to claim the dependent on their return, and they would be able to claim head of household status. But the key there is that the child lives with them for more than half the year.
Yeah, very good. Let's talk about qualified education expenses. What are we talking about there, and how's that going to apply?
Okay, qualified education expenses are the ones that will be available for the education credits on the return if you have them. They come down to tuition, fees, and books that are required to be paid for attendance at the institution that you're getting your education from. The educational institution needs to be one that is registered to that you could receive federal funding to attend there, whether it's subsidized student loans or grants of that type of nature to be qualified for the credit as well.
Yeah, very good. One question that we saw a lot as we were looking through things people had submitted online, what are the tax implications of withdrawing money early from a retirement account?
Okay. If you take money out of a retirement account early, which if you're under the age of 59 and a half, it's going to be deemed an early distribution. It will be, in most circumstances, subject to a 10% penalty along with the income taxes that is associated with the income from that distribution. There are some instances where, depending on why the money is withdrawn, whether or not you can be exempt from that penalty. One situation would be if you're unemployed and you're pulling the money out to pay for health insurance premiums.
Sure.
Another would be if it's being taken out for a first-time home purchase, which is one deal that the maximum amount of the distribution that would qualify for that exemption would be $10,000, and that's a lifetime distribution.
Okay.
So you can only do that one time. Education expenses for you, your spouse or your dependents would also exempt you from the penalty.
Yeah, so good to know about how that works before you start withdrawing money from that account.
Always good to ask first.
Yeah.
And then you won't have any surprises when it comes time to prepare the return.
Yeah, absolutely. Since we talk so much about home repairs here on this show, can I deduct expenses paid for repairs that I make to my home in a year?
Typically not. Expenses that are used to enhance the home, repair major repairs on the home, typically go into the basis of the home, which then comes into play when you sell the house and you're looking to see whether or not you have a gain on the sale. There are certain instances where it could come into play, and one of those is if you put enhancements to the house that qualify for a credit, and that would be like heating and air conditioning, environmental type things. Some credits are available for installation of those products. Another area that's not used all that often is if it's medically related. Okay. And if you can get a prescription from the doctor that says this particular enhancement to the house needs to be done for you for medical purposes, then you could deduct that on the Schedule A as a medical expense, and in certain circumstances get it exempted from sales tax.
Okay, very good information. It's time for us to take another short break here, but we're calculating a return in a matter of minutes. When we come back, we're going to look at 3 things to consider during tax season. We'll also take your listener questions and get you the answers you need straight from our expert today, Tim Dages. Stay right here. You're listening to Chat with the Experts, brought to you by Angie's List.
Do you love a good bargain? Angie'sList.com showcases popular deals from highly rated local companies so you can save time and money on the home and health services you need most. Remodeling your kitchen? Painting your house? Cleaning your carpet? We've got a deal for that. Angie's List members even have access to exclusive discounts, up to 80%. Don't waste another day or another dollar. Start shopping now at Angie'sList.com.